Hello everyone and welcome to Study IQ English. I am Joycey Joy and now we are going to discuss a very important topic, that is monetary policy quantitative tools. We know that monetary policy of a country is taken by the central bank of that economy. In case of India, it is the RBI or the Reserve Bank of India that takes the monetary policy. We have also discussed about Monetary Policy Committee, who is the dedicated committee for taking the monetary policies for the country. In the previous video, we have seen that. If you have missed the video, please do watch the video on Monetary Policy and Monetary Policy Committee. In this video, we are going to discuss about what are the different tools used by RBI or the Monetary Policy Committee in order to bring monetary policy or to implement monetary policy in the country. So we are only discussing about the quantitative tools in this video. In another video, I'll explain to you what are the qualitative terms as well. So first, let us come to CRR or the cash reserve ratio. CRR or the cash reserve ratio refers to the percentage of deposits. It is the percentage of deposits that the scheduled commercial banks or the banks has to keep with the RBI. So this is the percentage of deposits that the banks have to keep with RBI. Suppose the total deposits is 1000 and CRR is 4%. So 4% of 1000, that is 40 rupees, has to be kept by the banks with the RBI as a reserve. This is called as the cash reserve ratio. Currently CRR is 4%, but it keeps changing. And it is 4% of the net demand and time liabilities. That is 4% of total demand deposits and time deposits. That is a fixed deposits. So 4%. And the important point here to be noted is that banks do not get any interest for this. For keeping or parking this money with the RBI, the banks do not get any interest on it. All banks must keep CRR, and it is mandated under RBI Act of 1934. Next is SLR, that is statutory liquidity ratio. Statutory liquidity ratio is actually the deposits kept with the banks itself. So this is not RBI, with the banks itself, but it is mandated by RBI. So this is the percentage of deposits that the banks keep with themselves. Statutory liquidity ratio. Why it is called a statutory? Because it has been made a provision of RBI Act. RBI Act is a statute, it's a law. It has been made a provision under the RBI Act. So statutory liquidity ratio is the percentage of deposits the bank has to keep with itself. It can be in the form of cash, it can be in the form of gold, or it can also be in the form of government securities. Unlike in case of CRR, CRR has to be kept in terms of cash itself. It's cash reserve ratio. Whereas SLR, it's statutory liquidity ratio, which can be kept in the form of cash or in the form of gold or even in the form of government securities. So presently SLR is 18% and all the banks have to keep SLR under the RBI Act of 1949. Next is bank rate. Now the CRR and the SLR, cash reserve ratio and the statutory liquidity ratio. RBI counts this at a fortnightly basis, that is in every 15 days. Now, if any bank does not keep or maintain the CRR or SLR, they will be charged a penalty by the RBI. So this penalty comes in the form of an interest rate, which is called as the bank rate. Currently it is 4.25%. So this is a penalty interest rate charged by the RBI. Next is repo rate, which is very important. Repo rate is also called as the benchmark interest rate. So repo rate is also called benchmark interest rate. What is a repo rate? So in repo rate or in case of a repo rate, the bank can borrow from the RBI. So this is basically a repurchase agreement. Repo refers to repurchase agreement. Okay, so under the repurchase agreement, the banks can borrow money from RBI on a short-term basis. So the interest charged by the RBI on such short-term lending is known as the repo rate. Now what happens in case of repo? As it is a repurchase agreement, in case of repo, the banks sell their government securities to RBI and RBI lends money to the banks based on the government securities that the bank sells. Now, the government securities which are sold by the banks, there is a repurchase agreement that the banks agree to repurchase it back from the RBI on a specified time. So that is why it is called as a repurchase agreement. And based on the repurchase agreement of government securities, RBI can lend money to the commercial banks. And the interest rate for such loans given by RBI to the scheduled commercial banks is known as the repo rate. So basically, repo rate is the interest rate charged by the RBI on such short-term loans. So this bond here refers to government securities which the banks sell to RBI and agrees to repurchase it after a certain period. Repo rate was introduced in 2000. All clients of RBI can borrow from RBI against securities but not from SLR. What does it mean? We have seen that in case of statutory liquidity ratio, the banks can keep liquidity in the form of government securities or in the form of cash or in the form of gold. Now, government securities are also a part of SLR. So, this means that not from SLR here means that banks cannot use the government securities which is kept as a part of SLR to borrow from the RBI on repo rate. It has to be outside the SLR. So that is what is mentioned here. And loan duration is usually for 14 days, but now RBI has extended it and introduced long-term repo operations. So LTROs are there. We will be discussing about LTROs later. So now we have long-term repo operations as well. Currently repo rate is 4%, but every 2 months RBI's Monetary Policy Committee holds bi-monthly policy review and changes repo rate. So this is not permanent. And RBI uses repo rate to control inflation. This is important. Let's see how does RBI use repo rate to control inflation. As we said, repo is the rate of interest charged by RBI when commercial banks borrow from RBI for a short period of time. So, banks borrow money from RBI and RBI charges an interest rate called the repo rate. Now, when the repo rate is high, this means that the cost of borrowing for the commercial banks are high. When repo is high, cost of borrowings are high for the commercial banks. When the cost of borrowings are high, the commercial banks will borrow less. When commercial banks borrow less, they have less lending capacity. This means money supply will decrease, and a decrease in money supply will help in containing inflation. When the money supply reduces, this helps in containing inflation. Inflation reduces. Okay. Exactly the opposite happens when the repo rate is reduced. In order to ensure more investment and more growth in the economy, RBI often reduces the repo rate. When repo rates are less, the banks will borrow more. So, borrowings of commercial banks will increase. Therefore, lending will increase. Therefore, money supply will increase. Investment will increase. Economic growth rates would also increase. So, this is what happens when the repo rates are reduced. This is how repo can be used as an effective monetary policy tool to control inflation. I hope the idea is clear now. Inflation is increase in the prices of commodities or a persistent rise in the prices of commodities because the money supply is high. During inflation, money supply is high. So, during inflation, RBI tries to reduce the money supply by increasing repo rate, and during deflation or during recession, RBI tries to increase the money supply by reducing the repo rate. I hope the idea is clear now. So, that's how repo acts as an effective monetary tool. Next is reverse repo rate. So, here the exactly opposite of repo happens. Here actually banks park their surplus funds with the RBI. See, in this figure you will see the commercial banks can park their surplus of funds with the RBI, and RBI will give a interest on this. So, RBI will give an interest on the money that is parked by the banks under reverse repo. All clients of RBI earn interest from RBI by buying securities. Repo is a repurchase agreement. Same way reverse repo is also a repurchase agreement, but how? Here RBI is selling securities, government securities to the banks. In case of repo, banks are selling government securities to the RBI. In case of a reverse repo, RBI sells the government securities to the banks on a repurchase agreement that RBI will buy it back from the banks after a specific period of time. So this is how the reverse repo operations work. The loan duration is usually 14 days. Reverse repo rate is less than the repo. So currently the reverse repo rate is 3.35%. RBI uses reverse repo also to control money supply in the market. Let's see how. It's easy because you already know how repo rate is used. So when the reverse repo rate is high, banks will park more money with the RBI. Banks will park more money with RBI, which means that the lending capacity of banks are less. When the lending capacity is less, money supply will reduce. Exactly the opposite happens when the reverse repo rate is reduced. So when the reverse repo rate are less, banks will park less money with RBI. So lending capacity of banks will go up and the money supply will increase. So when the reverse repo rate is high, money supply will reduce, and when the reverse repo rate is less, money supply will increase. So this is how reverse repo can be used again as an effective monetary policy to control inflation. So this is another monetary policy tool. We have a few more monetary policy tools which needs to be explained in detail, like the open market operations, there is purchase and selling of government securities. Then we also need to discuss about LTRO, long-term repo operations, market stabilization scheme. These three schemes are very important and I will be discussing it individually. Thank you so much for watching. I wish you all the very best. Hope to see you in the next video.